morning. Welcome to the Brew. I am your host, Lex. And today, we have a good show today. We're going to be talking about the movie that's coming out, Dumb Money. So we're not really going to be talking about the movie per se. We're going to analyze the theme behind the movie, which happened with the what's now called a meme stock, GameStop. So Molly and I are going to break down what went on there and why some of these things may have happened. So stay tuned for our little discussion on Dumb Money. My favorite time of the morning, Mal.
Hello, good morning.
How are you?
Coffee, we're good to go.
I know. I'm ready. This one's going to be a deep dive, I think. Are you ready for this?
I love this subject. I mean, I feel like this subject is the evolution of trading and the future of trading. So I'm really excited about this topic.
Yeah, I am too. So it's interesting. You know, I'm probably going to take a little bit different tact than most do, only because of, my background on the market making side. So this is an interesting topic. Let's lay up the whole dumb money thing. What you haven't seen the movie. I haven't seen the movie yet. I know what it's about. I don't know if you know what it's about, but it was that whole episode during the pandemic, right? When the Wall Street bets and Reddit community, they got hold of a stock and off to the races they went. So it caused this panic in GameStop. GME is the ticker. It went from $5 to, I think, $500 in a short period of time, right?
Right.
And a lot of people made a lot of money. A lot of people lost a lot of money. Our job today is to get into the how did that happen scenario. So what do you think about those apples?
I love it. And since you are representing one side, I'm going to represent Wall Street bets.
Oh, you're going to be.
We got the two sides.
I like it. You're going to be the retailers in their pajamas in the basement trading up a storm during the pandemic.
Right.
And I'm not going to be Wall Street, but I'm going to be more the professional side.
All
How's
right.
that sound?
I'm Main Street. How about Main Street?
You're Main Street. I'm Wall Street, sort of, but not detestable yet. So I'm not the detestable side of Wall Street. All right, let's take a look at let's do a clip of Dumb Money. I think we have a clip ready to roll. Let's see it.
How much did we make today?
5 million.
And yesterday?
4 million.
We're like really rich.
GameStop now another record high.
Wall Street is betting that GameStop is going to fail. And if it fails, these hedge fund guys make a ton of money. They literally call us dumb money.
You got rich dudes coming at you. This is class warfare.
How much did we lose today?
$1 billion.
And yesterday?
$1 billion.
Dumb Money, exclusively in theaters, rated R.
I love
Pretty
it.
cool.
How much did you lose today?
Yeah.
$1 billion. How much did you lose?
Right.
$1 billion.
Right. This is a fictional representation of another documentary on HBO, Gaming Wall Street, which goes more into the details and the mechanics behind it all. So I haven't seen it, but we'll see how it goes.
Yeah. So I watched a couple trailers on that one. That one seems a little bit more cynical toward Wall Street than this one does, I think.
Oh, it does.
We'll talk about it. Yeah. We'll talk about it. Okay.
I personally am not cynical towards Wall Street as a retail trader. I think it's a platform, and it just needs to evolve. We're evolving together, and I don't have that kind of adversarial viewpoint per se.
Yeah.
But let's dive.
You know what? I'm not going to call you anymore. I'm not saying it. I'm not saying it.
All right.
Okay. So first of all, let's just lay this up, and then we're going to go to some slides. We actually have a slideshow today. Yeah. So what happened back in, I think it was 2021, is, obviously we're in the pandemic. Everyone's holed up in their homes. No one's going out very much. And this community, you probably know it better than I do, but Wall Street Bets and Reddit have social communities for investing in ideas, I think, right? And they talk about trades they want to make, and that sort of thing, right? It's not investment advice at all. It's just, hey, I'm going to do this. I think this is the next big stock boom, and kind of catches fire, right? Do you have any more details than my dumb version of it?
No, that's pretty good. And so Reddit hosted a board called Wall Street Bets, and it's that little blonde guy with the sunglasses and the red tie and the blazer. And so that when you see that image, it represents this whole concept of what occurred. And these guys go on, and the difference between these guys is that they turn their cards. So a lot of hedge funds keep the cards close to their chest. And these guys face the cards the other way and share information. So there's a lot of, new traders who are reading 10Ks, sharing information. Hey guys, I found this. What do you think about this? And also there's a name for which I won't say, but they actually display their losses as a prize. Like, guys, I lost this much today, or I won this much, and they're completely open about it. And then they take the meme stock comes from, they'll do, videos from movies, and they'll put a ticker over someone's head and reenact two stocks acting in, congruence or whatever's happening. So it's fun. It's like a fun way to trade.
Okay. Yeah. I like it. That was good. All right. Well, let's get into it, right? Let's break it down. We'll go through the slides, and we can come in and out of slides if we need to. Let's go through what happened. Okay. Sound good?
Sounds great.
Okay.
So, and adding one more theme, that this component it turned into supporting a stock that they love, but then it turned into a transfer of wealth from Wall Street to Main Street, and it became and then we'll review in the end what occurred with the halting of trades and why that happened. So Let's start with this. Let's lay it out.
We're just going to go through this. You haven't seen this for all practical purposes, nor have I, for that matter. So who knows where this goes? All right. So today on the Brew, Dumb Money is the name of the movie. We think it's coming out soon. Had a little pre-release. Hasn't done great at the box office yet, so we can discuss that maybe at the end if we have time. But this is a movie about, I'm calling it the GameStop phenomenon. So that GameStop was the company in question here. The ticker for GameStop is G Golf Michael at Echo, right? GME. That was the ticker. Okay, so as you said, these folks started chirping about it in their Reddit community, their Wall Street Bets community, and one of the big players started getting involved. So before we get there, let's first define the types of investors and traders, what I consider investors and traders. I don't want to use that word interchangeably, investors and traders. I'm a trader. Investors hold things for a longer term. Traders do things in and out. So I was more of a trader, right? So there's in this kind of breakdown, there's three types. I only have two here. We'll go to the third type last in the next slide. So there's a retail trader, right? We all know what that is. That's a group of traders. They're individuals. They buy and sell options and stocks in their own securities for their own personal accounts. They're not representing anyone else. They're just trading on their own. They're not professionals because they don't have the ability to stream markets. They have the ability to post their bids and offers, and hopefully they get filled, right? And they're doing it for their own account, right? Clear enough?
Great. Perfect.
Retail traders. Okay. Next up, institutional traders, investors. These folks, or entities for that matter, they're traders who buy and sell securities for accounts they manage, all right, or for their firm's own personal, own corporate account, let's say, or company account. So someone like, a big bank could be an institutional investor. They could be trading on their own book and making trades and putting on positions as they see fit, right? So far, so good?
Yeah, and you can actually go, so for any stock, for any ticker, you can go on Yahoo Finance. There's tabs right above the top when you put in your ticker, brings up the stock, and then you'll see these tabs, and all the way to the right, you might even have to click the three dots. There is holders, and to find the institutional investors for any stock, you just select holders, and they're all listed there. And so it's really good to know who's invested.
Okay, I like that because that's going to come up. Good point there. Okay, numero trace, number 3. This is the hidden, I call it the hidden type of investor or trade. It's more of a trader. This is the market maker or dealer. Now, market maker and dealer have been used interchangeably. I'm not sure, I always knew it as a market maker, but people have called it dealer lately. So I'm like, okay, sounds good. So I use those interchangeably, market maker and dealer. So that is the person. This is the group of folks who are making markets that retail trader and institutional trader can trade on. They are the liquidity source. They are posting continuous two-sided markets in everything they're assigned to. So if they're assigned to GameStop, these market makers, they have to post a bid and an offer for every option in GameStop going out into eternity, wherever options are listed on that stock. Okay. So
and in the rhetoric you hear when they're explaining in the context of GameStop shorting companies, they refer to a prime lender. Can you explain that as well?
Well, so what the people who are shorting this, so this is going to come up too in the slides, is that what the Reddit community, and again I'm using that loosely, the folks who started this cavalcade learned is that there was a large short interest in GameStop among the hedge fund community, institutional side. So they got wind of that. Just like you said, you go look at that on a Yahoo Finance board. So they got wind of that and said, hey, I don't think this stock's so bad. I think it's pretty good. It's got some upside potential, and I'm going to start buying it, right? So we'll see how that plays out. So yeah, those three types of investors are very important to this story. And how it worked out. Okay. So far, so good. Clear?
Really clear. Really
okay.
Great.
And I was part of the market making side of this. So that's where I existed on this side of it. Okay. All right. Now, what happened to GME? What went on here? And again, this is probably the poster child for the meme stock craze. It was this GME, right? So what we need to understand, I think, first is, the velocity of this move was just magnificent, this up move in GME. It went from $5 to $500 in such a short period of time. It was insane, right?
That's not a hockey. That's not a hockey stick. That's a Tesla,
my God,
SpaceX launch.
That's a fire pole.
Right.
That's except you're going up instead of down. It's unbelievable. So I think it's important to understand, how what each type of investor's role, how it existed in this whole machine and what they played in it, right? So first of all, retail trader first. So they got wind of this report that these hedge funds were short. And I'm not saying they were nefarious or not. It doesn't matter, because they said, we're going to get these guys. Ha 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 ha. Who cares? You know what? Right. When you put your money at risk in a trade, you can get whatever you want. So as long as you're putting your money at risk legally, no arguments about it. So they decided to band together. One guy, this Keith Gill guy, was kind of the leader of the pack. I think he decided first, hey, GameStop's really not that bad. I kind of like it. He's probably a gamer. He's sitting in his pajamas in his parents' basement, trading away.
Right.
During COVID, he's like, I think the stock isn't as bad as these hedge funds think. I'm going to start buying it. I'm going to announce to my community that I'm going to buy it. So the retail trader in this equation, which is amazing, they were the catalyst for the start of this whole move, quite frankly. They got this big ball, this big snowball up to the top of the mountain and pushed it. And it started running down the hill, and in this case, up the hill, running down the hill, and it started gaining momentum and gaining more snow and more mass. And this thing all of a sudden turned into this juggernaut to the upside, right? But it started here probably, right? Because they had a piece of information. I always talk about getting an edge, having some information that's obviously legal. You never want to do anything illegal. Having a legal piece of information, which they found on the holdings of this GameStop. They believe differently. They set the whole ball in motion, right? And, as you said, communication and this sort of knowledge, when you're sharing it in a social community like they did, it was bigger than we imagined, because, hey, listen, you're in the house, it's COVID, you can't go out. Now you're learning a new skill. The community banded together. They're all in close contact together, not at their other job per se. And it had a lot of weight. Now, I would tell you In the old days when I was doing this, I would say that a retail trader or a group of retail traders have no chance of moving markets. They're not big enough. They don't have enough money. But this proved otherwise in this particular case. They had enough money to get the ball rolling. And then what happened next is where it really picked up speed.
Yeah, and before we move on, we had seen this before in 2008 with Volkswagen. So that was one of the first times we saw this scenario occur. And then to explain what happened with the company itself, the idea is that they have these retail shops and kids come in and they can take their video game they've just conquered and they can switch it out for another one. And so it's very hands-on. Kids go into the store. And what came out at the time was Microsoft taking over Xbox and Xbox providing downloadable video games. So why would you need stores? So that was the backstory of the anticipation of the decline of the business model. But people who loved this company knew that their financials were great. They Cohen, I think that came down later, but Ryan Cohen was going to come in and mix things up and change things around. So there was some real fundamentals behind that decision on the retailers' end.
Right. Yeah, exactly. So listen, they had a belief and a thesis that GameStop was not the dying, bud on the vine or grape on the vine that these hedge funds thought it was. Again, legitimate. So you have a belief and someone else has another belief. That's what makes a market, right? So, okay, so far so good. So they started buying this thing, right? Remember, and we're going to get to this in a sec, who's selling them this stuff? They started buying calls. Calls, as we know, profit to the upside. It's a much more leveraged investment tool options, right? So they started buying calls. They started buying stock. So they started just getting long, these retail folks, right? And all of a sudden, stock starts moving up. Obviously, they're big, huge push from the buy side starts moving up. People are starting to move out of the way and say, hey, what's going on here? We're starting moving out of the way, right? All right. Next thing. These institutional players. Good bit of these. I can't remember. You might remember the name of the fund or do a Bard search real quick. They're one of those funds. It's probably the guy in the movie
Melvin.
who's represented. Yeah, that's
it. Was Melvin. Yeah.
They had the biggest short position in GME, but that Melvin company had a short position. They thought this was going to fail. GME was going to go to zero, and they're going to make the difference between where they sold GME and zero, or where they thought it was going to go, $1 or whatever. So they had a big short position. The retail Wall Street bets folks learned of this. They said, okay, good. Now, whether they wanted to kind of take it to them or not, I don't know. Maybe, who knows? But it's a market, right? So these short players, all of a sudden, as the stock starts going up, they're starting to get margin calls, meaning they're losing money. They need to have more money to sustain that short position. They have to either come up with money or what? They've got to buy in some of those short shares and take some of that off the table if they can't come up with more money. So now we've got Wall Street bets retailers buying calls, buying stock. That's putting upward pressure on this thing. Institutional players all of a sudden say, hey, wait a minute, I'm getting my what handed to me. I'm starting to lose my butt. So I'm going to start covering some shorts. I'm going to start buying, right? Pushing more, making that more upward pressure. So all of a sudden this GME stock is starting to, skyrocket, right? But it's the last group that's the most interesting group. Okay. And that group is what I did for a living, and it's the market maker. Okay. So the market maker, in my opinion, played an even, they were the behind the scenes role in all this. Right. And listen, Citadel was at congressional hearings and Ken Griffin was speaking about it. There is enough, stuff thrown against the wall for the market makers here. But, these guys and gals, it's their firms now, they are providing the liquidity for all these people to trade on. They provide the two-sided markets. When someone wants to buy a call, these people sell it to them. When someone wants to sell a call, these people buy it from them. Okay, two-sided markets. So these market makers were on the other side of these calls that were being bought, right? So what does a market maker have to do? They are ruled and governed by the Greeks. And we've talked about it on the show. delta, gamma, theta, vega, rho, among all the other subgroups. We're going to hit on one a little later in this little talk here. So they got caught, this market makers got caught in what's called a gamma squeeze. Okay. So what happened was, remember, we already have 2 levels of pressure upwards from the retail and the institutional person, right? The third level was this market making group. They're selling calls to the retail Wall Street bets folks. They are delta neutral people, these market makers. They want to be flat. They don't have exposure. So when they're selling calls, look at my hand signal, selling calls. They're selling calls. Yes. They're getting short when they sell a call. What do they have to do to be neutral when they sell a call? They have to buy stock. So when they buy more of this GME stock, all of a sudden, who's left to sell this stuff?
It's
right?
pressure all over.
It's pressure. It's retailers buying it, institutionals covering, market makers just covering their short calls just to buy in deltas to be flat. Okay, so that's what they do. So when you have a position on where you're short calls, okay, or short any option for that matter, overall, you're going to get what we call negative gamma. Okay, and it's a Greek that we use in trading. So the importance of this market maker behavior is the following. I said this already, they remain delta neutral over stock price movement. So as stocks move up and down, they are constantly adjusting their deltas by either buying or selling stock or doing other trades to kind of mitigate exposure of delta. Okay. Remember, in this instance, they're getting short deltas as they're selling more and more calls to the community of people who are buying them from them. Okay. They've got to buy stock, upward pressure. So these market makers are always managing their Greeks in all their inventory with all these hedges. Okay. They accumulate edge by buying and selling on their, buying their bid, selling their offer all the time. That's all they do. Right. And they manage risk. Managing risk, the big part of the equation is remaining delta neutral. They don't care about direction. They just want to manage their inventory so that they can capture that edge that they have. Right. Ask a question, Mal, even if you don't understand. I know this is heady.
No, this is really great. So just to clarify, market makers, where the position you held, you are non-directional, to clarify.
Yeah. So, right. Non-directional. We don't
so you always
care
want to
about
keep that balance.
up or down. Right. Now, look, someone's going to say, that's not true, Lex, anymore. I know Susquehanna takes up. Yeah, look at their market maker firms have some opinion, but they overall, relative to the size of their books, they remain fairly neutral. Okay. That's they have too much edge built into the system. Okay. And when I say that, they're taking risk, bid, offer. And when they take risk, they hedge it so that they mitigate the risk. It goes away. That's why they hedge it, because they've got so much good edge in the bid and the offer. Okay. So it's really important to understand that. Now, some of the residual effects of having this inventory on, it's all one way. They're short calls. Just forget about it. I'm just short calls. That's what they had. They get what's called gamma. Okay. And when they are short options, they get what we call negative gamma. So gamma is defined as the rate of change of delta. Okay. It tells traders, this Greek gamma tells traders how much his or her deltas will change over a $1 move in the underlying asset. So if you have negative 1,000 gamma, okay, let's take GME. And GME goes from, I'm just making it up, from 10 to 11. Your deltas are going to get shorter by 1,000 when it goes from 10 to 11. Okay. So if you have 0 deltas at 10 and it now goes to 11, you're short 1,000. Remember, they want to stay neutral. What do? They're probably buying a little stock all the way up until they kind of keep it to 0, or buying options, or doing something that whatever they can get to get those deltas back. Now, in a high velocity environment like this, there's a lot of buying. There's a lot of running for this stuff. And you can't imagine the notional value of gamma with this market maker book, right? So keep that in mind. If it goes from 11 to 12, they've added another 1,000 gamma there. So now they're at 2,000 delta short up there. So now they're really scrambling, and so on and so forth. They went from 5 to 500. You can imagine what went on there. Okay.
So explain a gamma cluster.
So yeah, we're going to see that in a little bit, but let me tell you what that's. So we look at the SPX a lot for the market, overall market. to see, you know, kind of where moves can exist in the overall market. So in, you know, modern day data, which we all have access to now, some geniuses figured out how to decide and how to look at where the market maker or dealer has negative and positive gamma. So in TradeHawk, for instance, we have a tab, and I'll show you that at the end, that shows where gamma for the dealer lies. Okay, so a cluster would be where big negative gamma or big positive gamma that the dealers hold exists by strike. So at those points where there's big negative gamma, there's chance for higher implied volatilities and higher volatility moves, because dealers have to do the opposite kind of thing with negative gamma. And where big dealer clusters of positive gamma exist, you tend to have stickiness around that strike, because every time it runs up above that strike, you're getting long, dealers are, and they're selling stock, which drives it back down toward that strike. And when they get short underneath it, they buy stock, and it kind of pushes it back up to that strike. So it's kind of a pinning effect. Okay. So that's what a gamma cluster is. It's where dealers have lots of inventory and they have to make decisions, whether they're long gamma or short gamma. They have to make a decision, and lots of them. Does that make sense? Mo?
Yeah, that's great. It's really interesting. And to pause for a second, TradeHawk is the company that you built.
Yeah, that's right. So TradeHawk is the software we use for trading. You know, it's more of an advanced piece of software for options traders, and it's got a lot of analytical tools, especially around implied volatility and these gamma clusters and what have you. So that's what that gamma cluster is. All right. So let's see what this slide is. So here's the gamma squeeze part of it. Did I spell squeeze right? That looks right, doesn't it? I think that's right. So as I've been explaining, the market makers sold these calls to the retail traders, and probably some institutionals. They're probably trying to hedge their inventory, right? And when inevitably these market makers had to buy stock, again, pushing the stock even higher. Okay. Don't forget, as the market makers kept pushing the stock and everyone kept pushing the stock up in this upward spiral, their short gamma kept kicking in even more. Okay. So as the stock kept going higher, they kept getting shorter, and they kept having to reach for more stock, and it kept exacerbating the problem. And then you have the hedge funds come in and say, I got to buy stock too. It's going high. And you see what I mean? It's a compounding effect. It's like a snowball rolling downhill. It really is. In this case, rolling uphill. So all this further hedging, you know, got to a point where the stock's $500. I couldn't believe it. I don't think I've seen anything like this to the upside in my life, as bad as this was. Now, once the hedging factor wears out, meaning we're well beyond gamma and there's nothing else out there or up there, all of a sudden this behavior stops. There's nothing more to hedge. It's all hedged from down below, right? You can only get to 100 delta. So you can go from 0 to 100. That's it. Once you get 1 to 1, you're done. Unless they establish a new short or a new long, right, somewhere else on the curve, then it kind of stops. So this ultimately did stop, right? And what happens to options with this sort of move? Okay. Implied volatility goes freaking straight up. This was such a violent upside move. Okay. Implied volatility skyrocketed. It just went nuts. Now remember, these out of the money calls that they're short, we have another factor working. It's called Vana, and we're not going to get too deep in it. It's a suborder Greek, but it tells you how your deltas change on implied volatility moves. And if implied volatility is going higher in out of the money options, okay, out of the money calls we'll talk about here, right? Those deltas are going to tend toward 50. So if you have a 30 delta option, right, and it's going higher, there's a higher probability it's going to be the money. It's going to start tending toward 50 and going that short delta is getting bigger because implied volatility is going up. So on top of the hedging part, they're getting shorter because implied volatility is going up on top of it because of Vana, and they're buying even more to get themselves back to flat. So this whole market maker gamma squeeze, Vana squeeze concept was really powerful. And I guarantee you not many folks knew that was going on behind the scenes. The regulators, the Congress people that went through this, no one talked about this so much, right? But this underneath the scenes was a lot.
You never hear about this.
Right. You never hear about this. So this was really, really one of the
No.
pivotal key parts behind the scenes that was going on with this just massive velocity move, right? So here's a little picture from TradeHawk, right? And we'll end it here. So this is GME, and this is current. So, you know, again, these numbers are way smaller now, but you can see this is kind of the at the money. There's a little negative gamma down here. I'm sorry, a little positive gamma on the downside. These are puts down here. Now look at this little short. This is negative numbers. This is upside calls. So the 20 strike has a little short gamma in it for the dealers, the 18 strike. So there's a little short gamma to the upside in GME even to this day. I think if this continues like this. If you look at an SPX chart, it's completely the opposite. Most traders and institutions, they'll buy downside puts to sell upside calls. It's a big collar position, so they can hedge their portfolios, right? Because most people are long stocks and what have you. So to hedge your portfolio, you're going to buy a put, sell a call. The dealers are doing the opposite. So they're selling puts, buying calls. So their downside tends to have the negative gamma. Their upside tends to have the positive gamma in most normal indices and what have you. This is kind of flip-flopped here. Does it make sense, Ma? It's nuts, isn't it?
Yeah, absolutely. This is beautiful, by the way.
It's
Yeah.
another beautiful.
And by the way, if you ever you're step to TradeHawk, yeah, you can contact Lex directly and ask him questions. Can't believe that.
So this is the part where I give you my
amazing.
home number and my bank password and my username. Is this when I do that part?
Yeah.
No, I'm just kidding.
Right.
Right.
Right. It's
No,
1-800 Trading Hotties. If you're
there you
wondering.
go. There you go. I love it. So that was quick. I know we went through that pretty fast, but just in summary, okay, we had a community that believed in something, okay, and they had good information to believe in it. Okay, I'm not going to comment on whether it was good or bad. So they banded together, meaning some guy said he's going to do it, and everyone piled on and followed. He didn't instruct them to do it. He said, "Here's what I'm doing," and they jumped on. Perfectly fine. It caused a domino effect. So the domino effect was institutions that they knew were short.
You're referring to, yeah.
Oh yeah, Roaring Kitty, and yeah, I think was that the Keith Gill guy. I don't know what his handle was. I forget. But he started got it rolling, got involved. He made a lot of money. I think. I don't know if he kept it all, but he made a lot of money. $50 million or something like that. That's a pretty good day. Institutionals jumped on because they had to cover. They were getting pinched. They lost a lot of money, right? Market makers, they probably lost initially because they sold cheap calls at first, and they only the value of those calls kept going up and up and up because implied volatility kept going higher. They're selling these things along the way. So ultimately, the market maker probably did pretty well. Early on, not so well, had to cover, had to chase,
Okay.
Low volatility. They sold, got much higher. They got to sell higher volatility. I think by the time this was said and done, I want to say the stock was trading around $400, and the 800 call with a week to go, maybe not even a week, was like trading $12. 400 points out of the money. That call was $12. One lot represents 1,200. I know a good friend, colleague of mine who said, "This is ridiculous. Enough's enough." Sold a bunch of those 800 calls at $12-ish, let's say, and never even got tested. Never looked back and made a pretty good number selling those. But listen, the market maker at the end of the day, they got hurt early, probably. They totally made it all back and then some. They did fine once they got their bearings and volatility settled in, and they kept selling higher and higher volatility, hedging, managing, all that sort of thing. They did fine. The people who got hurt, that probably middle institutional class they learned about, they probably got pretty banged up on this one, I'd say. And I don't know what the Reddit community did. If they got out at the highs,
and just to clear,
hallelujah, good for you. Go ahead, Mel.
Right. So what happened is that the DTCC announced from Robinhood and other brokerages that there was overnight, almost 100% cap requirement, and so they turned off the buy button. So they halted trading. They still allowed the buy button. So a lot of retail traders were upset because Melvin got out, and then the stock started to fall because that buy button was halted. And that might be a show in itself to understand
Yeah.
how the DTCC or the OCC works. And the neat thing of the difference between a DTCC and the OCC is actually much safer. So when they're, when we talk about naked shorts, what the OCC does to keep an eye on that, a quantitative versus a qualitative, and they have a much bigger team that make sure that that's secure. So that's where I just, again, fall towards options, and I love options because there's also that added security there for us. And
Right.
I like that component. Yeah.
Yeah, I mean, in the options game, you don't have to go find you don't have to go find the shares to short them, right? So you don't have to locate options, right? You do have to locate stock. And my feeling is, and I think this is accurate,
if
the
you're
short shares, because there's so many that were short, there's nothing more to borrow. So people are getting called in on short shares too. So that also had an upward effect. You got to buy those in when you get called. So that was also, I didn't touch on that, but that probably happened a good bit to the Melvin Capital hit all those short shares as well. So yeah, that can cause a little stickler too. There's a lot of things going on here to that upside move, right? But it just all happened with a short little pin drop in the forest, and it multiplied its way out, just rippled. And all the investor classes got involved on this one. They all, some were good, some were bad. So what do you think, Mal? Unreal?
Yeah, we have, a couple more to look at is AMC, Kodak, Virgin. So they're also sort of playing in this field that Volkswagen and GME played in. So we'll keep an eye on those. And there's also some
we'll talk about maybe we'll
meme ETFs that are now out there if you don't want to find a specific one.
Yeah. No, that's all good. Well, there's a meme ETF too. I saw that. So that was interesting. We'll talk about that on another show. The other thing too is when Matt comes on again, we could talk a little bit about locating stock and shorts and all that stuff and hard to borrows. And there's some good option themes around those special situations, especially with interest rates and what can happen in that environment. But this is good. I'm glad this show came out. Now, the only bad news is that that GME is, that whole phenomenon is a couple years old now. So it's a little old news. So, the only reason we're really talking about it is because the movie's coming out. We wanted to kind of review the details of what's going on and just give some color to what actually happened. But otherwise it's kind of old news.
Yeah. And I think right? It is probably not to a lot of people. This movie's coming out and this might be the first time they've ever heard of it. So it's we'll keep an eye on it and as it grows and as the exposure. And I think it's really great because retail traders have had a taste of it. And with I think where this phenomenon occurred was not necessarily COVID first. It actually occurred in the housing crash. And that's where we saw people lose their jobs and started to get into investment and started to understand that. And this was the second component. And so I think it was a long time coming. And then going forward, it's really where a lot of people may feel that they are watching news and they are affected by news. But this is where you can actually band together, support, let's say you're a musician and you know everything there is to know about publicly traded stocks that are in the music industry or the instruments or throwing a concert. You can actually go and invest in that sector. And that's what we talked about. We'll talk about with Paulina on Friday, diversification through sectors, and she'll probably help us understand how this component, these great retail traders that band together on Reddit in a specific subject matter really can strengthen trading because they know the product themselves, where sometimes institutional investors are very far removed from the product. So there's this really nice balance in healthy trading and supportive stocks.
Yeah.
And,
no, I agree.
Yeah.
I agree.
It's exciting.
You know what else? We're out of time.
All right.
And you know what else? I'm going to say now, if you like this kind of content, make sure you subscribe to us, right? And hit the like button. Send us a comment.
Right down there. Yeah,
it's down there somewhere. Hit the like button. Subscribe to Options Brew TV. Subscribe over to Tradier as well. What else? Send us some comments.
Come meet us at the hub.
come meet us at the
Got
hub.
a lot of content
Absolutely
there.
Yeah, and then any kind of comments if you want to see certain sort of analysis of trades, of specific trades or general trades, let us know. We're happy to cover all that stuff. So tomorrow we got the guys for Traders Workshop, but Paulina, you said on Friday, and then next week we got Matt coming from OCC again. So we got lots of stuff coming.
Exciting.
I know. All right, good deal. That was fun.
Right.
I will see you soon.
All right.
All right.
Thanks,
Ding ding.
Lex.
Bye.